Hi, everyone. Thank you for joining the webinar today on how to do a backdoor Roth IRA. We are going to get started in about another minute or so, so I'm just going to have the presentation slides up and running for the time being, but I'm going to give it another minute as people I see are still trickling in as far as attendees. If you have a question, please go ahead and start posting them to the question chat box on the bottom right of your screen. Okay, I think we can get going now. So first off, thank you again, everyone, for joining. I hope you can hear me. If you cannot hear me, actually, we'll not know if you can't hear me, but just, again, post your messages or your comments in the chat box, and we'll go ahead and get started. So thank you for joining the webinar today on how to do a backdoor Roth IRA. My name is Ara Ogorian, and I'm with ACap Asset Management. We have a lot of people on the webinar today, so please, again, if you have a question, type it into the question box, and excuse me, at the end of the presentation, I will go ahead and answer all those questions, assuming we have time. So here's a quick roadmap of what I'm going to cover in today's webinar. First off, it's important to talk about the target audience. The target audience is important because this webinar may not apply to you depending on your circumstance, and I'll cover that in the next slide. But if the backdoor Roth IRA does still apply to you, then we'll go ahead and discuss the importance of the Roth IRA. We'll talk about how to implement the backdoor Roth IRA, again, if it does apply to you. We'll talk about the importance of the Prorata Rules, because that is extremely important when you're trying to implement the backdoor Roth IRA. And then lastly, we will discuss Form 8606, which you must file with your tax return if you're going to do the backdoor Roth IRA, or if you're going to do any sort of non-deductible IRA. And lastly, we'll obviously have plenty of time for questions. So I want this to be interactive. Please go ahead and post your questions in the question box on the bottom. So the target audience, the backdoor Roth IRA is only for high-income earners, because if your income is below the IRS limits, you can directly contribute to the Roth IRA, and you do not need to use the backdoor strategy. So what are those limits? If you are married filing jointly, this is as of 2017, if you're married filing jointly and your modified adjusted gross income is less than $186,000, then you can directly contribute to the Roth IRA, and you do not need to do the backdoor strategy. If you're single and your modified adjusted gross income is less than $118,000, again, you can directly contribute to the Roth IRA, and you do not need to do the backdoor strategy. Here's where it gets a little tricky. If you are married filing single or separately, married filing separately, then that limitation, that threshold, drops dramatically down to $10,000. So please do analysis before you determine whether married filing separately applies to you, because not only does it limit you on the backdoor Roth IRA, or just not only does it limit you on the Roth IRA, but it also limits you on many other eligibility requirements. So married filing separately, the modified adjusted gross income threshold drops down to $10,000. So if you earn more than $10,000, you cannot directly contribute to the Roth IRA. So why is a Roth IRA so important? First, there are all investments fall under three tax buckets. They're either tax-deferred, tax-free, or they're taxable. If you are in the tax-deferred bucket, you get a tax deduction for any contributions you make, and those contributions grow tax-deferred. So common examples of a tax-deferred bucket investment would be a 401k, an IRA, a simple IRA, SEP IRA, pensions, anything that you get a tax deduction now, but you'll have to pay tax on it later on. The tax-free bucket are Roth IRAs and Roth 401ks. You don't get a tax deduction now when you make that contribution, but the real benefit comes later when you take the money out, and you do not have to pay tax on it later. So you don't get a tax deduction now on the tax-free bucket, but the money grows completely tax-free. And the third bucket that investments fall under are things like savings accounts, real estate, brokerage account, things like that, or rent that you receive from rental properties. Those types of accounts are taxed every year as you receive interest, dividends, rents, and you have to pay tax on those. So again, all the investments fall under these three buckets. Now, usually most people have the bulk of their investments in the tax-deferred bucket, which are the 401ks and the IRAs, because that's where they've been contributing to their company's 401k plans. But our philosophy here at ACap is we firmly believe you should have money in all three types of buckets. And the reason behind that is because we don't know what tax rates are going to be 1 year from now, let alone 10 years from now. So if you have money in all three tax buckets, then you have options when it comes time to take money out or when it's retirement time, and you can selectively choose which bucket you want to take money out of that's going to provide you the most tax advantage situation at that time. So for example, let's assume that you're retired and for whatever reason you need to take out $100,000 and you have money in all three buckets. You can choose which bucket you want to take money out of depending on what tax situation you're in at that time and what tax rates are at that time as well. But if you have all of your money in the tax-deferred bucket, then you really have no choice but to only take money from that bucket. And if tax rates are really high, then you'll have to pay tax at that current rate. So now let's discuss the meat of how to actually implement the Backdoor Roth IRA and how to actually fill that tax-free bucket. It's important to note that the law says you cannot, if your income doesn't qualify, you cannot contribute to a Roth IRA if your income is above any of those numbers that I mentioned earlier. But in 2010, that law changed that said anyone, regardless of their income, can take a regular IRA and they can convert it to a Roth IRA as long as you pay tax on that conversion. And that's where really this backdoor strategy really started from. So the key words here are contribute and to convert. So what you're going to do is first you're going to open up a traditional IRA. And you can open this up at TD Ameritrade, Scottrade, any discount broker will be able to open up a traditional IRA for you. Next, you're going to contribute $5,500, which is the limit for 2017, into a traditional IRA. The next step is, and which is the most important step, is you're not going to deduct that on your tax return. Now, I repeat, you are not going to take that deduction on your tax return for making that contribution into that IRA. Once you've done that, at the same time, you're going to open up a Roth IRA, preferably at the same institution that you open up that first traditional IRA. So now you have your traditional IRA opened, you funded it with $5,500, you have not deducted it, and you've got your Roth IRA that has zero money in it. What you're going to do is you're going to take the money that's in your traditional IRA and you're going to convert it to the Roth IRA. And you're going to do that, when you do that, there's no tax implication because, number one, you have not deducted that traditional IRA contribution on your taxes. And number two, if you do it quickly enough, soon after you've opened and funded it, the money has not had a chance to grow for you to have a tax liability on that growth of that money. What I mean by that is, let's assume you opened up your traditional IRA, you put $5,500 into it, you didn't deduct it, but that money grew to $6,000, and now you converted it to a Roth IRA. Well, when you do the conversion, the $5,500 you don't pay tax on because you never deducted it. But that growth of $500 you have to pay tax on because that was in a tax-deferred type of account. So it's important for you to do that conversion relatively quickly so that way you don't have any growth in that traditional IRA and you're not going to have any tax liability from that. Very important part of the Backdoor Roth IRA is what is known as the Prorata Rules. So before you actually do a Backdoor Roth IRA, you have to take inventory of all your other IRAs that you might have. In this case, let's assume that you have a rollover IRA, you have a SEP IRA, and maybe you might have a simple IRA in there as well. If you do a non-deductible IRA and you try to implement that Backdoor Roth IRA strategy, you're going to have tax consequences, because when you do that conversion, they're going to look at all of your other IRAs as well that are tax deferred. In this case, your rollover IRA, your SEP IRA, and your simple IRA, and they will factor those in. They'll take a pro rata portion of that, and you'll get taxed on that pro rata portion. The way that you can avoid the pro rata rules and the way that you can avoid taxation or surprise taxation is if you have a pretty good 401k plan at work. And what I mean by good is if you have a low-cost 401k provider with relatively good investment choices, you can take your existing rollover IRAs, SEP IRAs, or simple IRAs and transfer them into your existing 401k plan. Again, assuming that your 401k plan is a good 401k plan and allows you to do that incoming transfer. Once you've done that, you basically zeroed out all of your tax-deferred type of accounts, and all you have remaining is that last non-deductible IRA that you made a contribution to. Once that's happened, then you take that non-deductible IRA and you can convert it to the Roth IRA. It's also important to note that once you've done that conversion, you keep your non-deductible IRA open even though it's got a zero balance, because what you're going to do is you're going to use that as a destination account the following year when you do this Backdoor Roth IRA strategy once again. Okay? So very important that if you have other IRAs, that you do not do the backdoor strategy unless you are able to transfer those other IRAs into an existing 401k plan. Another important step that you have to do when you do the Backdoor Roth IRA is that you have to complete what's known as a Form 8606 on your tax return. Now, there's no tax implication for completing this form as long as it's done correctly. But if you don't do it, then you're going to potentially expose yourself to double taxation in the future. Because the purpose of the Form 8606 is to show the IRS you did an IRA contribution, but you never deducted it. And if you show that you never deducted on your tax return, and later on as you take money out of your IRA, you can clearly show that you never received a tax deduction for it, and you can avoid that double taxation. Unfortunately, this last step is usually forgotten by CPAs or people who are doing their own taxes because they're just not familiar with the form. So it's really important, if you're going to do the Backdoor Roth IRA, do the Form 8606 and make sure you don't fall into the trap of the Prorata Rules. So that is how you implement the Backdoor Roth IRA strategy. Now we'll open it up for questions, and again, please, you can type in your questions on the bottom right of the chat box. All right, so we got one question coming in as far as where you can open up your accounts at. Again, I mentioned earlier you can either open it up at any discount broker. You can open up at TD Ameritrade, at Schwab, at E-Trade, at Scottrade, any one of those places. You can open up your IRA to do the backdoor strategy. Make sure that your non-deductible IRA and your Roth IRA are both opened at the same place. It's going to provide that transfer much easier and much smoother. If you work with an advisor such as ACap, obviously we will do that backdoor strategy for you. We will file for also doing your taxes. We will also file that 8606 for you. But you can open up at any discount brokerage firm. Okay, there's another question coming in about the pro-rata rule. So if you do have, the question is if I do have a existing IRA, my 401k does not have good investment options. So if your 401k does not have good investment options and you do have other IRAs, unfortunately, the benefit that you're going to get from doing the backdoor Roth IRA may be negated by the poor investment choices you might have within your 401k. So if you don't have good investment choices in your 401k, I would recommend that that you keep the backdoor Roth IRA, that you don't do the backdoor Roth IRA, and maybe fill the taxable bucket. Just getting to the questions. Is it better to use a traditional 401k or the Roth 401k or 50-50? That is a great question. The question again is it better to use a traditional 401k, a Roth 401k, or split it half and half? And the answer to that is it depends. And if you recall in the earlier slide I mentioned, if you have multiple buckets where your investments fall under. You have the tax deferred, the tax free, and I'll pull up that slide right now, and the taxable. If you've got most of your money in a tax deferred bucket, then and you need to start filling up that tax free bucket, then I would say start contributing more to the Roth 401k to fill up that tax free bucket, and then that way you'll have a little bit of balance between all those tax buckets. Also, it depends on your tax situation at that time. If you really need a tax deduction in the current year, then whatever money you put into the Roth 401k, you're not going to get a tax deduction now. So you may be better off putting it into the traditional 401k so that way you can get a tax deduction. So it depends on a number of variables. It's better to do some analysis before determining whether or not to split them between the two options or to put them all into one bucket. Okay, next question. So if you implement the backdoor IRA, you cannot contribute to a tax-deductible IRA going forward. Yes, that is correct. So if you want to do the tax-deductible IRA, that's fine. You're going to get a tax deduction for it, and that money is going to grow tax-deferred, which is completely fine if you want to continue filling the tax-deferred bucket. But if your intent is to get into the Roth IRA and to fill up the tax-free bucket, then you want to do the backdoor Roth IRA strategy that I just described. Let's see the next question. Can you transfer an old 403b into a backdoor Roth? Yes and no. It's a couple-step process. What will have to happen is you will transfer your old 403b into a regular IRA, and then from the regular IRA you would transfer it into the Roth IRA. Now keep in mind, if it's an old 403b, that's tax-deferred money. So you got a tax deduction when you put money into that 403b. When you convert it to the Roth IRA, what's going to happen is you're going to owe tax on the value of the money that you convert to the Roth. So for example, if you've got $20,000 in your 403b and you convert it to the Roth IRA, you will report $20,000 of income that year and pay tax on it. But then that money will grow tax-free in the Roth IRA. Okay, we've got a lot of other questions coming in. Do I have to wait for one tax filing cycle to wait to convert a traditional IRA to a Roth IRA? No, you can do that conversion anytime you want. There are some schools of thought that say don't do the conversion immediately because of what's called the step doctrine. So they recommend funding the non-deductible IRA, waiting a few months, and then doing that conversion. And then there are some people that say you can do that conversion immediately and it won't raise any red flags. So to answer your question, you don't have to wait a full tax filing cycle to do the conversion. You can convert it at any time you want. Okay, next question. We already answered that one. There was another question about whether to do a traditional IRA or a traditional 401k or a Roth 401k or split them. I think I already answered that. It depends on what your current tax situation is and where you have the bulk of your money currently. can you invest in any funds or buy any stocks with Roth, or are these limited to other funds only? This is a great question. So the question is, can you invest in any funds or buy any stocks with a Roth IRA, or are they only limited to some funds only? You can invest anything you can invest in with a brokerage account, with a Roth IRA or a regular IRA. You can do in all those. You can do in a Roth IRA as well. So you can buy any type of investment you want within these IRAs. These are just types of accounts. They don't create limitations for you on the types of securities you can hold. So you can buy individual stocks, you can buy bonds, you can buy mutual funds, either in an IRA, a Roth IRA, or a SEP IRA or simple IRA. Next question: does having a Roth 401k get taxed if you use a backdoor Roth? If I understand the question correctly, no, it does not, because the Roth 401k you're making contributions to through your employer, and you're not getting taxed on that when you are not getting a tax deduction for that money when you make the contribution, and then when you take the money out later on during retirement, you're not going to pay tax on that. So it is independent of whether or not you do the backdoor Roth IRA strategy or not. Next question is, do you have to pay income tax or capital gains tax on the growth in the backdoor Roth IRA? You don't pay capital gains tax on the conversion or any of the IRAs, but if you contribute that $5,500 example I mentioned earlier, and then you wait until that money has grown to, for example, $6,000, and then you convert it to the Roth IRA, that $500 of growth you have to pay tax on. But you don't pay tax on the basis, which is the money that you put in, as long as you did not deduct it. Okay, next question. I have an existing Roth and a traditional IRA, plus a work 403B. Do I have to roll over these accounts to my work account to be able to do a backdoor Roth IRA? Yes, you do. Only the traditional IRA. So the Roth IRA, the existing Roth IRA, you can keep the money in there as it is. But your traditional IRA, you would have to roll it over into your company's 403B plan for you to be able to implement that backdoor Roth IRA strategy. Otherwise, because of the Prorata rules, the money that's in your traditional IRA, you will have to pay tax on that. Okay, next question is, what is the maximum married filing jointly can contribute to a backdoor Roth? So if you're married filing jointly and your income qualifies, the maximum you can contribute would be $11,000 as of 2017, which is $5,500 per individual. Now, if you are over 50, if you're 50 or older, you can contribute $13,000, $6,500 per person into the IRA, either a Roth or a traditional IRA. Okay. So one more question. Do you roll over into a Roth? I'm trying to read the question. Give me 1 second. This is a great question. Does a spousal IRA count in the Prorata rules? It does not. So this is a really good question. If you and your spouse, if you have traditional IRAs and you will not be able to do the backdoor Roth IRA, but if, for example, if your spouse does not have traditional IRAs, they would be able to do the backdoor Roth IRA, because even though you have a balance in your traditional IRA, the Prorata rules do not commingle your two accounts, because the IRA itself stands for individual retirement account. So each IRA is an individual account, and it stands separately from the individual. So if your spouse has traditional IRAs, it will not affect your ability to be able to do the backdoor Roth IRA. one more question. The maximum you can contribute, again, is for 2017, it's $5,500 if you're under the age of 50. If you're over the age of 50, it's $6,500. And you can also, if you're married, each one of you can put in that $5,500 or that $6,500. One thing to also note is if one spouse is working and the other spouse is not, you can piggyback off. The non-working spouse can use the working spouse's income to qualify to contribute to the Roth IRA or any IRA, because to be able to make a contribution into an IRA, you have to have earned income. So if one spouse is not working, they can use the working spouse's earned income to qualify for the IRA contribution. Okay, I think that was the last question. Thank you again for participating in the presentation. Hopefully this was helpful for you. If you have any questions, my contact information is down there below. I'll make it a little bit bigger so you can see it. Oops, my contact information is right here. And thank you again, everyone, and look forward to our next webinar.